Hello everybody and welcome to another video on financial analysis, and today we are going to be looking at the Universal Music Group. Now Universal Music are at the time of recording about to do an IPO, an initial public offering. They're going to float their shares on the stock exchange and you will have the opportunity to buy them. And so what I thought we'd do is just have a quick look at their financial performance and to see what the numbers are telling us about the business. Now, a couple of caveats here. Do remember that all we're looking at is the financial numbers. We're looking at what's happened in the past. We're not talking about the future. So we are going to be looking at their prospectus. There's a lot of other information in there. It's on their website. So do, if you are looking and wanting to conduct some fundamental analysis of this business, do download the prospectus, do take time to read through it yourself and to draw your own conclusion. So this is just looking at the financial statements, and the financial statements will tell you what's happened in the past and will not necessarily tell you about what is happening or going to happen in the future. However, it should form part of your financial or your sort of fundamental analysis. So Universal Group, what do? Here they are. So if you haven't heard of them, quite a long a comment here from their website. Universal Music Group is the world's leading music company, exists to shape culture through the power of artistry. They're a community of entrepreneurs committed to creative innovation. They own and operate a broad array of businesses engaged in recorded music, music publishing, merchandising, audio visual content, etc., etc., etc. So they're kind of, they're in the music business. They deal with artists and recording labels. They have the rights to music, and that's effectively where they are making their money. So if you want to know more about them, have a look at their website. Tells you lots and lots of the information you need to know, and the prospectus we're going to talk about is also available on their site. So that's what they do. Once again, this is a request from one of our viewers. So thank you very much to Shodem Armin, admin rather, who asked us to have a look at this. So this is the video. And please do like, share, subscribe to the channel. So liking the videos, sharing the videos helps other people to see them, and do subscribe to the channel. Again, you will then receive notifications of when we post a new video, and I hope you find this useful. Don't forget that not only are potential investors or investors using these videos, but they're also useful for anybody who's studying for accountancy exams or just wants to improve their ability to read the financial information of a business. So without further ado, let's jump in and have a look at the financial statements of this company and see what the numbers are telling us. So if you visit the website of Universal Music Group, you will find this prospectus. So it's a publicly available document, and it talks, this particular one talks about admission to listing and trading of all ordinary shares on the Euronext Amsterdam, which is the trading bourse in Amsterdam. And lots of information about the business. So you can see through the contents, things like important information, forward-looking statements. So this is the projection of what they think is going to happen in the future. Things like their dividend policy, etc., etc. And then towards the end, you can see things like business industry overview, who they are, what they're doing, etc., etc. So there's a lot of information in here. Don't forget, they're going to be putting their best foot forward. They're going to be talking it up. So here is the income statement, and you'll notice the income statement is stated in euros. So we are dealing in millions of euros, and we're looking at these three accounts. So these three accounts, these are the statutory accounts. You'll notice that they are audited. So they've also provided some unaudited figures for the 6 months. So the 6 months up to the end of June 2021. Which is the kind of the latest set of financial data that they've got, and they compare that with the first 6 months of 2020. Okay, so we're going to be keeping an eye on this line here to see what's going on, but we're also going to be focusing mainly on these three numbers. They are the financial statements. They are audited. We have a lot of confidence in those figures. So what do we see to kick off with? Revenue is 7 7.4, so that's 1,000 million, so that's 7.4 billion, and that is up about 4% on the previous year, which is up a fairly significant amount on the year before that. So this is a company that's growing, which is good, and you can see here 3.8 billion for the first 6 months. So we'd expect, you know, they're going to be, you know, again, maybe that's kind of what's that, 7.6, you know, again a small increase if they manage to sustain that. The cost of sales, the cost of revenues, is the cost of the company of generating that revenue, and they are operating at about a 47% margin, gross margin. And that's pretty consistent across the last 3 years, 2020, 2019, and 2018. So very, very consistent in terms of their gross margin. Net margin. Here's the operating profit. Actually, they don't give me an operating profit. This is, I guess, yeah, EBIT. So this is our operating profit here. They're operating at about a 16% operating margin, a little bit up from 15% 2019, 14% 2018. So the reasonably good operating margin. And bottom line, here are here's the kind of the earnings straight down the bottom. I think I just need to scroll down a little bit. Let me clear my annotations and scroll down, and we can see the bottom line. They are making a profit of 1,369. So this 1,369, this bottom line here, this is about an 18%. Okay, so up from 14 and 15% in previous years. So that's pretty good. Bottom line net margin. Interesting enough, quite a big number sitting in here in this other financial income. I don't have any information about that, but that looks like it's skewing the numbers quite high. And you'll notice here that we kind of, you know, maybe expect it to kind of drop back a bit, although it was quite high in the first half of the year. So that part of that 453 will be in this 603, so to speak. So maybe that's a kind of a little bit of a distorting a set of figures coming through there, but again, you know, it's a profitable business. Okay, and that's what we're taking from this, and it's pretty good margins, and it's growing. So there's our income statement. Let's go and look at our balance sheet. So here is the balance sheet, and you will notice that this company has total assets of, at the end of 2020, about 11 billion euros. And similar number for the end of June 2021. So it hasn't really changed. Point out some of the big numbers. So up here we can see goodwill, which is basically arrives on acquisition. So it means that they've grown through acquisition by buying companies. And the other big number, by far their biggest number, is their content. So this will be the cost of the royalties that they own, for example, that create the stream for them. So this will be their kind of, you know, their content, the actual physical content that they use in terms of their music rights, etc., etc. They've got some non-current financial assets. You know, this could be kind of cash on deposit, so to speak, but just you know, parked for a long time. So you know, and that's a guess. In terms of their current assets, nothing really just kind of jumps out at us. Quite a lot of accounts receivable, and a reasonable amount of cash, about 326 million euros of cash. So balance sheet looking, you know, pretty reasonable from the assets side of view. If we scroll down, we can see the liabilities. Now we drop right down here. First of all, here's the current liabilities. So the current liabilities, you remember, we are looking at, you know, this number here. This is the end of 2020, and this is the 6 months to the end of June 2021. And what we see here, quite interesting, is that suddenly we've got this short-term borrowing. Now, this short-term borrowing, in fact, is a reclassification of a long-term borrowing. So what we can see here is at the end of 2020, there was a loan by their shareholders, which is Vivendia, and this has been converted into a short-term loan. So we'd expect that to be repaid on flotation. and this is quite interesting because there's also, if we go back to the assets, we can see that there's also loans by this company to the to the shareholder. Again, not so big. So this is, they kind of been, they're basically pulling these two companies apart. They're pulling Universal Music out of Vivendi and trying to kind of ring fence it. So this shareholders loans, we'd expect that to kind of net off and go to zero on the flotation. The other thing we noticed when we look here is the current liabilities are a lot bigger than the current assets. So the current assets for year ended 2020, for example, are about 3 billion, and the current liabilities are 4.7 billion. So, on a basic level, from a liquidity basis, that's kind of, a warning sign to us. However, we feel, this company, they will be getting the money in long before they pay it out. So we'd expect them to be able to sort of survive, based on their strong cash flow. So, not like a traditional manufacturing business where, the cash goes out and then the cash comes in. These guys, it's cash in, then cash out. So they're allowed to, or they can operate at that lower liquidity level, although they just, they don't want to go too low because, and again, they're fairly sort of consistent streams. So, even if we go back into sort of lockdown with COVID, they're still going to get those revenue and the royalties coming through as people listen to their music. What else do we see here? So, really that's the kind of the big number that's jumping out at us. In the non-current liabilities, again, we can see that, so that their long-term debt has gone to kind of almost to zero because of this reclassification. And the other thing to notice, which I couldn't quite work out. So first of all, what we do see is the retained earnings. So if we're looking at the equity, the retained earnings have fallen significantly. And I think what they're trying to do here is that they're trying to take there's an element which is attributable to the Vivendi shareholders. So what they're trying to do is to kind of, they're trying to ring fence the retained earnings that relate to the shareholders. And what we see here is they've restructured it. So the bottom line is pretty consistent, but they've restructured it by almost reclassifying retained earnings as equity investment. So they've kind of boosted the share capital, they've boosted the paid in capital. Now, this is just an accounting adjustment, but it's just interesting that they've done that really ahead of the IPO. And I can't think why they've done it. Maybe somebody's got some insight as to, why they're doing that, and could, help me out in the comments. Do provide your a little dividend. They pay a small dividend of 283 million euros during 2020, and they made a profit of 1.4 billion, and yet their retained earnings has gone down. And there's no movement in equity note that I could find in this prospectus, so I'm a little bit at sea on that one. So I'm not sure exactly what is going on there. Anyway, so the balance sheet is, it's an interesting balance sheet because it hasn't really changed. The total equity is still, if you think about, the total assets compared with the total equity, it's still a very, similar picture. So I don't know. I mean, it looks like there's a kind of a big reclassification going on. But the that debt, really that's the sort of the big one, this debt, the reclassification of the long-term debt into short-term debt in the last 6 months. And that's a classification. So that's, but it does mean that, the money that we are, if you are investing in this, a lot of that money is going to go back to the, the original shareholders, as a way of, paying off their debt, 2.4 billion. Here's the cash flows. So looking at the cash flows, now quite interesting on looking at the cash flows, the one thing that does jump out at us is negative cash flow from operating activities. Now, not sure that's necessarily a big issue because we've got the content investments up here, and you can see that, that, you know, they're generating cash at an EBIT, but there's a lot of content that they're buying. Now, I'm interested that they've got the content in that section, because I would generally think of the content as an investment, and therefore I would stick it in here because it appears in the non-current assets. So quite why it's appearing there, I'm not sure. So I think we probably want to just take that out, put it in here, and decide that actually these guys are, you know, they're very cash generative. They are generating lots of cash, and they're doing that because of their business model, as I expected. So I wouldn't get too worried about that -3 million of cash. I think they are investing, and you know, as we said, the investment numbers I think look pretty low. So this is the kind of the investment, and so they've got investing activities, and they've got these divestitures as well, which is where they're selling. So they split the two out. But if we take the two together, we end up with their investing activities, which is this line down here. And they're pretty small numbers, and I'm sort of surprised at that. It looks low, but I think that they've got the, you know, they've got the investment in content, which is really what we're interested in terms of, you know, further up in the cash flow statement. So if you're investing in, I don't know, Coca-Cola or you know, BMW, you want to know that they're buying manufacturing facilities, and you know, and maybe that they're buying other companies as well. Whereas these guys, that, you know, they really want to be buying content. They want to be buying artists effectively. In terms of the financing, so down here we've got the financing. So here we'll see, you can see the distribution. So they've been paying out dividends to their shareholders. You know, what was the dividend policy? Well, there's a note on their dividend policy going forward, so you can read that yourselves to see, you know, whether they're planning to carry on distributing, or whether they're going to stop distributing. But you can kind of see that, you know, almost there's kind of these last gasp, you know, they're trying to get, you know, the owners are trying to get, you know, as much money out as they possibly can before they sell it, so to speak. And down the bottom here, nothing really kind of, you know, that jumps out at us in terms of the financing activities. So really, it's kind of, you know, other transactions. I'm not sure what these other transactions are, but you know, that's you know, several years ago, so we're not too worried about that. And you know, really here we can see that there's not a lot of cash used for financing activities, and they have quite a lot of cash. So you know, they have a reasonable amount of cash sitting on the balance sheet. You know, here we go. So they've got the cash, but they've also got these loans that they have given to the shareholders. So there's their cash, and this is the loan to the shareholders, which is too much cash. We've parked some with Vivendi, and that's absolutely fine. That's what, you know, a group of companies will do. They'll pool their cash, for example, and they'll allocate it, you know, where it needs to be allocated. And you can see that by the end of this period, you know, that's a pretty small number. So the company we're looking at has got lots of cash. This is the IPO company. This is the company that you might be buying into if you should decide to buy into, and very little in terms of, you know, what is owed to it by the share, by Vivendi, for example. So, you know, they're pulling the two companies apart. So that is effectively, those are the kind of, you know, those are the big numbers, and you know, then we've got a whole lot of other financial data, and it takes you through you know, most of the, you know, the detail, and gives you some more information. So you know, in terms of whether we want to be buying into this company, well, you know, we have to think about what price we might be paying for it. So a quick Google of, you know, what's the IPO price. I've seen a number of prices kind of mooted around, but you know, I've seen things like, you know, $40,000 or $40 billion or 40 billion euros, you know, given that the, you know, exchange rates are not a million miles away from each other. So if, for example, the flotation price was 40 billion euros, and let's use that number as a kind of as a guide price, that's 30 times earnings. It's quite expensive. The earnings yield is 3.4%, you know, which is pretty low. But again, we live in this low interest rate environment, and you might think, well, you know, it's a pretty solid low risk business. You know, I'm prepared to take that. there is a dividend yield, but again, you'd have to look at the dividend policy to see whether that's relevant. It's only 0.7%, so it's pretty small. They've only got 1.4 billion of net assets. So, if they float at 40 billion, it's going to be all goodwill, inherent goodwill effectively. So the price to the book value is very, very high. 40 billion is about 5 times sales, if you remember, about 7.5 billion. So that's about 5 times sales, if that's a metric you want to use. And you also want to think about the sort of the growth rate. So there is quite a big growth rate. If you look at the earnings growth rate, they've gone from 975 to 1.4 billion. That's a 40% growth rate. Now, I'm not convinced, that underlying profitability, because I think there's a kind of, there's some numbers that we're not expecting to see again, if that makes sense, in the kind of the other financial income. But even so, that puts us on a PEG ratio, what's known as a PEG ratio, of about 0.72. And if you use a dividend growth as well, or the dividend yield, and you've got a PEGI ratio of 0.71. As a general rule, the lower the PEG ratio or the PEGI ratio, the cheaper the stock is. So in terms of this business, looks pretty good to me. I don't know the music industry that well, so difficult to sort of comment exactly and provide any insight there. But the company it's profitable, it's generating cash, it's got a reasonably strong balance sheet. It looks like it's set for it's setting sail into the kind of the listed market. And it looks a reasonably strong company, if obviously they can deliver on their and execute their strategy. Is it a buy? I don't know. It's if you think you're getting a good value, or you think you're investing for growth, and you see that this company is growing, then it doesn't look like it's going to fall over anytime soon. Let's put it like that. So thank you very much indeed for watching the video. Once again, if you do have any comments, if you want to add anything, a little bit of insight about the industry, the company itself, then please do leave your comments in the comment section. Don't forget to like, share, and subscribe to the channel. And if you have a company that you'd like us to look at, can't guarantee that we will look at it. But if you do have a company, then you're welcome to drop that in the comments box, and we will see what we can do. So thank you very much, and I look forward to seeing you all on the next video.